What's up, everybody? Market's a little bit crazy, and two huge companies reported earnings. You might have guessed it by the title, talking about Microsoft and Google. This video is on Microsoft. We're going to do another one today on Google, and these are quick hits. So let's get to it. We're going to break down the earnings report. I'm going to pull out the key points that I think investors should know about. We're going to look at the valuation of Microsoft and whether or not it's undervalued or overvalued. And I'm going to tell you if I own the stock or not. So stick around. All right, here we go. Here are the key points from Microsoft's earnings report. We see they reported generally accepted accounting principles, GAAP EPS of 222, and that beat by 3 cents. They reported revenue of $49.4 billion, and that beat by $350 million. So we like to see that. They beat the expectations. That's not only management's guidance, but also Wall Street's expectations for earnings per share and revenue. That's called a top and bottom line beat. I love to look at their press releases and the earnings reports and dig in and pull out the points that I think are most important. So we're going to talk about, so we saw that they beat revenue guidance, but at this scale, $49 billion, they increased revenue by 18% year over year after a really strong year last year. Very awesome. Operating income was $20 billion, up 19%. Again, very strong. Net income, $16.7 billion, and that was up 8% for GAAP and up 13% for non-GAAP. This is important for me as an investor in overall tech and cloud or cloud computing or SaaS, software as a service style companies. Continued customer commitment to our cloud platform and strong sales execution drove better than expected commercial bookings growth of 28% and Microsoft cloud revenue of $23.4 billion, up 32% year over year. Another key highlight, LinkedIn revenue increased 34%, which is kind of crazy. Who even uses LinkedIn? Well, apparently a lot of people, and apparently a lot of people in this market who are very active in either hiring or job search or whatever services LinkedIn provides. Talked about that intelligent cloud. It was $19 billion in revenue, up 26%. Their server products and cloud services revenue increased 29%, driven by Azure, which is their public cloud service that had revenue growth of 46%. That's a strong report all around from Microsoft. And as an investor in tech companies and cloud companies, that is very bullish in my opinion, because it shows that the demand is definitely there from businesses spending on those services. Let's take a look at whether or not I think Microsoft is over or undervalued. So right now, according to Fast Graphs, we see it trading at a blended price to earnings ratio of 29. Since 2009, which I'm purposely excluding the great financial crisis, they've grown operating earnings at 14.5%. This orange line represents a PE ratio of 15. They've traded at a normalized PE ratio over that time of 19, represented by this blue line. We can see here the stock price. And so right now, based on its current estimates, even out to its normalized price to earnings ratio over this 13-year period, Microsoft looks very overpriced. That doesn't mean I think it's going to crash, or I think the market's going to crash. Just from looking at its history and the current stock price and the current multiple and its growth expectations, it looks pretty overvalued. If we take this from, this is yesterday's price really, so it'll be even higher today. If we take this from here out to 2024 at a price to earnings ratio of 19, we're looking at a minus 4% annualized return over the next 2 to 3 years. But we can't just really look at it at face value like this. We see that from 2010 to 2013, Microsoft really traded at a pretty low price to earnings ratio. So that might be skewing this normalized price to earnings ratio. So let's cut out those dates and see if we get a better normalized price to earnings ratio. So now the normalized price to earnings ratio is 23 if we're going back to 2014. That seems a little bit more reasonable, but there's a problem here. We also have the post-COVID extreme where it traded at a much higher price to earnings ratio than it historically had. So that's skewing the average price to earnings ratio higher. So let's take out COVID. And in my opinion, this gets us a pretty reasonable average price to earnings multiple for the premium that investors put on the business during whatever we might consider normal times are. And so we're looking at a normalized price earnings ratio of 20. That's still down 25 to 30% from here. So let's look at, if we go to forecast and we remember 20 and we take this out to 2024, right around a price earnings ratio of 20, we're looking at an annualized rate of return of -2% or a total return of -5%. If we take it up to 21, we're looking at just barely a positive return. In my opinion, and this is my opinion only, I love Microsoft as a company, fantastic company. The stock has been a major winner, but for me, I think it's overvalued based on its current multiple and future growth expectation. And there's other companies that I own in my portfolio and I've shared on this channel. So if you want to see those, just look at the playlists of the portfolio reviews that I've done and subscribe to the channel. I'm going to do a full portfolio review. I do it at the end of every week. So on Friday of this week, I'll show you exactly what I own in my portfolio in the companies that I think are better buys for me than Microsoft. Let me know in the comments if you own Microsoft. Am I wrong? Is it undervalued? Are you super bullish on it?